Well, hello and welcome to Global Mantra, the show that brings to you prominent fund managers from the City of London and gets their views on the global market situation. Joining me on the show right now is Nick Timberlake, who's the global head of emerging markets at HSBC Global Asset Management. He directly overlooks $10 billion with his team. Nick is right here with us. Nick, thanks very much for taking out the time. Really appreciate it. Give us a sense of how you're looking at your portfolio right now, given the macro risks globally and the fact that we have seen in the first quarter of this calendar year outflows from the entire EM pack.
I think you're right to highlight there are some risks at the moment. There are always risks when you're investing in the emerging markets, and I don't think actually today is anything dramatically different to many of the other risky periods that we've been investing through over the last 5 or 6 years. Today we're still actually quite optimistic about the outlook for the asset class. Yes, we're definitely going through a period of consolidation in the markets, but I think that's probably more a healthy period of consolidation. I think it needs to be seen in the context of what went before. Obviously last year we saw markets rise in the mid-teens. The year before that markets rose well over 70%. So when you take that into account, I think it's right to expect that we should have some kind of correction at this point in time. Yes, there are a few things that we should be worrying about, but I'm sure we'll get through those. And I'd be surprised if we don't finish this year higher than where we started it.
So do you expect this year to be net positive for emerging markets despite the outflows that we've seen so far?
I think so, yes. And I think, in fact, there are a number of markets that are positive this year. I mean, countries such as China, probably a lot of people are worrying about their investments in China. There's a lot of headlines about a rising inflation, slowing growth. That's not a great combination, but the markets are up year to date. In many of the petrodollar economies, the markets are up. Russia is a good example. The market's actually already produced a double-digit return so far this year. So it's not all doom and gloom for the asset class.
But there is a need to protect one's portfolio, right, given these risks, especially the risks coming out of the Middle East and the impact can have on crude and the kind of exposure that EM portfolios and developed market portfolios would be having to the commodity. How are you looking at protecting your portfolio?
Yeah, I mean, there are risks as we've discussed. I mean, I think the key is not necessarily minimizing the risk, but having the risk in the right place. So one key area that people are quite concerned about these days is inflation. I think that's probably the most important risk to focus on. And higher energy prices is not good for inflation, particularly in those countries that don't necessarily have energy of their own and need to import it. So we look at that and we take that into account. But I think the market is good at discounting these kind of risks, and an awful lot of the inflation worry, I would suggest, is already starting to be priced into stock prices.
Are you ascribing a discount to your investments in some way or to the valuations of emerging markets in the light of these risks, or are valuations, you think, pretty fair post the correction?
I think, emerging markets trade at a discount to developed markets today. Now, you might argue that for political, geopolitical, economic reasons, emerging markets should trade at a discount to the developed world. But if you look at some of the key drivers, I think, of stock market returns, such as return on capital of the companies and the speed with which those companies are growing, in fact, the emerging markets stack up very attractively versus the developed world. Then when you consider things like the debt problems that still exist in the US, Europe, and much of the rest of the developed world, then I think that discount, I wonder whether it will still exist 3 to 5 years from now. It does exist today, and that gives me added confidence that the valuation levels are not extreme.
But how do you ascertain how much discount would there be for emerging markets?
That's a good question, and I think you have to think about each company on its own merits as well as relative to another country. And if we take an extreme example like Russia, Russia is actually probably our most favored market in the world today. That market is always trading at a significant discount to the asset class as a whole. So if we use price earnings as a way of describing valuation, then the long-term average for emerging markets is about 13 times earnings. The long-term average for a country like Russia is about 9 times earnings, so a big discount. Whereas Russia, relative to its long-term own history, is currently trading on about 7 times earnings. We think that is a very big discount to the average for markets as a whole, and too big a discount relative to its own history. And that's before we start thinking about the opportunities to see faster earnings growth there, and there definitely are some given where the oil price is today.
Do you think India is fairly valued at 14 times 1 year forward?
So India is more expensive. So India is, if you like, at the other end of the extreme. You've got Russia at one extreme, and then you've got India at the other end of the spectrum. And obviously India has a number of structural advantages that other countries simply don't have. The key being the demographics of the country, which are incredibly attractive in terms of the age of the population, the profile of the population, the GDP per capita, and the direction in which that's going. So I think that is a reason why India may be able to exhibit higher levels of growth in the next couple of decades than some other markets. And as a result, India, you said 14 times. What's the long-term history for India? It's more like 16.5 times. India is, for the first time in quite a long time, we think looking more attractive than it has historically. Now, you don't get me wrong here. We have been very underweight and negative the Indian market for a long period of time. Today we're neutral, the market. But if we saw a further correction from here, I think we might actually get bullish on the Indian market.
Do you see a further correction from here in India?
Difficult to say. I mean, the Indian market stabilized in the last few weeks, and there have been more scandals in India. We've had a budget which was pretty uninspiring, and yet the market has found a floor. So there's definitely, valuation is often the most important driver of markets, and this has been in a period when the oil price has gone from 100 US to 114, which is more inflationary pressure potentially for India, and you would have thought maybe that would push the market down, but it hasn't. So a lot of money has left the Indian market. The market's fallen somewhere in the region of 20% from its highs. Maybe we're finding a floor here.
Is that, in a way, building a scenario for re-rating, so to speak, for the entire EM pack?
Yeah, I mean, I think EM has been re-rating now for nearly a decade. You have to go all the way back to post the TMT bubble, 9/11. That was pretty much the bottom of the valuations for emerging markets, and we've seen a steady re-rating versus the developed world. Obviously, in absolute terms, there's been lots of bouncing around, but relative to the developed world, we've seen that re-rating taking place. Now, the frontier markets are a step below that. It's going to take some of these countries decades and decades, really, to emerge to be mainstream emerging countries, but others are closer to that. A number of the Middle Eastern countries, I would argue, are closer to that sort of arriving in mainstream emerging world, and there's still some valuation interest there. I mean, the UAE is an interesting area. Abu Dhabi, we have a lot of exposure to the financial sector. There you can buy banks in Abu Dhabi at a discount to their book value. There aren't many places in the world that you can find banks trading at a discount to book value and generating mid-teens returns. Usually discount to book value means losses. We don't see losses. Okay,
out of your portfolio size or the assets under management, which is about $10 billion, how are you allocating across EMs? Which are the markets that you're most bullish on? Which are the markets that you are perhaps completely avoiding? And does caution mean exit in some of the markets?
Yeah, I mean, of the big markets, it's unlikely that we're going to exit, to be frank with you. But yes, we are prepared to take big positions relative to what the underlying market cap would suggest we might do. As I mentioned earlier, my favorite market today is Russia. I think Russia stacks up in valuation terms. I think also with the energy prices rising, we saw the energy price rise from mid-June last year. Oil was $70, Brent crude, to $100 before all of the problems in North Africa and the Middle East started. And so yes, we've seen the oil price rise another $14 from there, but I think it's only that last little bit, if you like, of oil price rise which can be really attributed to the problems in the Middle East and North Africa. And with an oil price which is likely to stay high in our view, because both stronger demand for oil and also all sorts of cost push issues on the supply side. It's more expensive to get the new oil finds out of the ground. Taking that into account, a high oil price for the medium term is likely to mean that Russia is one of the countries which generates the fastest level of earnings growth as well.
But have you changed your portfolio positions over the last 3 months? I mean, from the start of the year to now?
I think the biggest change actually has probably been in India, where we had a very cautious view. We had a significant underweight position relative to our benchmarks and probably the peer group. And where do we find ourselves today? We're about neutral, the Indian market, and we've added a lot of money to India over the last couple of weeks. It's a market obviously that's getting a lot of negative press, negative attention, but come back to the points I was making earlier, I think this market is stabilizing now. We haven't actually yet gone overweight the market. We still think there is a risk that maybe we see further derating, and if that happens, we'll be looking to buy.
All right, with that we come to the end of this segment, but up ahead we'll be discussing specific opportunities in India and also the position that it holds vis-a-vis China in the emerging market pact.
I think in the energy sector, obviously, a number of the companies in the energy sector do benefit from the rising oil price. I think there are a number of things taking place in terms of new developments in the energy sector. This year, as things stand today, the consensus view is that inflation will finish 2011 lower than 2010. But with this high oil price in recent times, that I think is maybe going to delay the story of reduced inflation to some degree. It's a key risk that we're worrying about, not just in India, but in many other economies that are susceptible to rising soft and hard commodity prices.